Now we'll take a look at part 2 in the Constructing Financial Statements series. Again, we're looking at Rocky Mountain Catering. The Constructing Financial Statements videos for Rocky Mountain Catering will assist you in completing a set of financial statement assignments in this course and help prepare you for the review problem at the end of the course. We're following Rocky Mountain Catering from the formation of the firm, referred to as the initial condition, through the first year of operation. We'll use the information provided to construct a set of initial balance sheets, the company's first year income statement, a year-end balance sheet, cash flow statement, and statement of stakeholders' equity. Here we'll remember that Jessica and Sean have invested in a new business. They've decided to take their love of barbecue and Dutch oven cooking, making sourdough breads, and convert it into a business. They've had some good success with family and friends who love eating at their home or eating out with them, but now it's time to see if they can really make some money at this rather than just have it as a hobby. You'll remember they put $50,000 of their own savings into this business, and they put $100,000 in the way of a loan into the business. And they began the business with some catering contracts with friends, former associates, and co-workers, and are hoping that they can parlay these, plus some great social media reviews, into a good first year. We looked at the balance sheet, and now I'd like to take a look at what happens next. Well, the initial balance sheet you'll see represented here just as we did in the video we did on the balance sheet. Out of that 50 plus 100,000, they spent $40,000 in buying some equipment, a barbecue on trailer, some refrigerators and ovens. They bought $20,000 van, and they spent some money on kitchen equipment. They ended up having $90,000 in cash left. And we saw that this was represented in the left-hand side of the balance sheet and the right-hand side of the balance sheet. But now we want to take a look at an income statement. Remember, if the balance sheet is a snapshot at a moment in time, the income statement tells us about transactions that have taken place over a period of time. There's 3 possible forms of income statement that we might have to think about. One of those is going to be for a production-based business with a cost of goods sold. And Rocky Mountain Catering would be an example of this. It produces barbecued goods in a catering contract or a catering environment. It produces artisanal sourdough breads. It has costs for those, and it has operating costs in addition to those raw material costs and such. We might also think about a service-based operation with what is commonly referred to as cost of sales. In service, we think about cost of sales. In production, we think about cost of goods that we sell. And then we'll think about a service-based operation without any cost of sales. We'll take a look at an example of each, beginning with an example from Rocky Mountain Catering. Well, here's the income statement for the first year. And without going into detail on the numbers that you see on the right, I just want to show you the structure of it. All income statements, as in all businesses, begin with revenues. We will then separate out or subtract cost of goods sold, and what we're left with is called gross profit. Sometimes you'll hear this referred to as gross margin, but frankly, that's inaccurate. A margin is a percentage. It's a ratio. It's relative. And in fact, a gross margin is the gross profit divided by the revenue to get the percentage of the revenue that is represented by gross profit. Technically, this should be gross profit. Well, once we know the gross profit amount, then we can subtract out any operating expenses or any expenses that are necessary for running the business that are not the cost of the goods that we're selling. That's going to include depreciation. And you might wonder why we include depreciation when you already know that depreciation is not a cash expense. Because we must recognize that depletion of value of those assets that we're using in the operation. Even though we spent the money when we bought the equipment, we recognize its depletion of value through depreciation while we're using it or in the years in which it's becoming depleted by use, by obsolescence, etc. When we look at depreciation, depreciation is the depletion of value of a tangible asset. It has a correlate by the name of amortization, in which we might recognize the depletion of value of an intangible asset. Regardless, on a revenue-based income statement, in this case for a production-based operation, we begin with revenues, we subtract cost of goods sold, that leads us to gross profit, we subtract all of these different operating expenses, and that leads us to operating income. You'll sometimes hear of operating income referred to as EBIT. And EBIT stands for earnings before interest and tax. Well, there may be some expenses in the company that are non-operating expenses. And an example of a non-operating expense very commonly would be interest expense. Once we have the operating income, we can then subtract out non-operating expense, and that results in taxable income. From our company's taxable income, we can identify then any taxes that we owe and must be paid, and this results then in our net income, which is commonly referred to in business as profit. So now let's take a brief look at a service-based operation with cost of revenue or sometimes cost of sales. It looks exactly like a production-based operation, only instead of having cost of goods sold, we have cost of revenue. Now this may seem like a nuance. A cost of a good that we sell, in the case of, say, barbecue, might be the cost of pork ribs, the cost of barbecue sauce, the cost of the wood that we put in the smoker, the cost of any foil or tin or paper plates that we're using as we wrap these things up. Those are going to be considered cost of goods sold. In the case of a service business, we call these kinds of things cost of revenue, but they aren't goods. They're not material. They're probably services offered to our company by contractors, by maybe some of our employees. And we're going to reduce the revenue by that cost of revenue and result in gross income, which sounds a lot like gross profit, but it's called gross income when we're looking at a service-based business. Well, here we're looking at Bear River Associates, and you can see the numbers here on the right-hand side. A moment ago, we were looking at Rocky Mountain Catering, and you saw their numbers. And notice that on this income statement, we have our revenue category, we have our cost of goods sold category, operating expense category resulting in EBIT, or operating income, non-operating expenses, and then our taxable income minus taxes paid, resulting in net income. For Bear River Associates, a service-based organization, we have a number of categories of revenue. We have a cost of revenue resulting in gross income, and then we have the operating expenses. Well, examples of operating expenses for both of these kinds of businesses might be wages, rent, sales and marketing programs, but notice that depreciation is on each of these. Here's depreciation in the catering business. Here's depreciation in Bear River Associates. If you see depreciation on a company's income statement, you know there must be long-term or some fixed assets that they're using to help them in the business. Well, that's obvious in the catering business. We have the refrigerators, we have the freezers, we have the ovens, we have the big barbecue smokers, and many other things. But in a service-based operation, that may simply be computers, possibly even furniture and equipment. This all results in our operating income, or EBIT, from which we're going to subtract non-operating expenses. And then that takes us to taxable income, from which we subtract taxes paid, leaving us with net income. Here we're having an example of yet one more. This is a service-based operation without cost of revenue, where all we recognize is the revenue coming into the company from customers and clients, and then we recognize all the various operating expenses. In this case, we don't think of these expenses as being cost of revenue because we probably can't connect them directly to the operation. Here in Bear River Associates case, where we used independent contractors, or maybe we had commission and fee expense, we could connect those to the production of the revenue. So if we're using an independent contractor, they're coming in to do something for us. If we're paying a commission, then that's because we sold something. So we can connect those activities, the selling and the providing of services, directly to the creation of revenue. But maybe in an architectural firm, there's simply a few architects where they're paid salaries and they bring in architectural revenues, they bring in consulting revenues, and they get their salary of X. Maybe it's $100,000 a year, maybe it's $70,000, maybe it's $125,000, but they get that salary regardless of how much they bring in any given period. It's a different formation, a different structure of an operation. Notice that in this case, we've got wages, sales and administrative costs, rent, and once again, we see depreciation. It's a non-cash expense. We spent the cash when we bought the equipment, but we recognize the use of that money as the asset is depleted, as the asset's used up, as it has wear and tear on it, as it becomes obsolete. When we have our total operating expenses leading us to this EBIT category or this operating income, then we have some non-operating expenses resulting in taxable income, taxes paid, and net income. Well, let's come back to Rocky Mountain Catering. Here we see the income statement for Rocky Mountain Catering, and we'll take a look at some transactions in just a moment that helps us put together this income statement. So in this case, the company had $600,000 in catering revenue in their first year. Not a bad first year for a little startup. It also sold $150,000 in some artisanal sourdough bread for a total of $750,000. It spent $300,000 on pork products, beef products, chicken products, all of which were smoked, maybe some salmon, flour for the bread, all the other things that go into the making of the catering products and the artisanal breads. It ended up with a total revenue of $750,000 minus the cost of goods sold, resulting in a gross profit of $450,000. Well, they also leased a commercial kitchen space for $4,000 a month, so $48,000 for the year. They spent $12,000 in that first year on social media marketing. They had a combined payroll of $180,000 and had to pay employer-sponsored taxes and benefits as part of that. And they had some general and some administrative costs of $125,000. So you can see each of those, the $48,000 rent for the year, $12,000 marketing expense, $180,000 in payroll, $125,000 in general administrative costs, and here is their depreciation for a total of $372,500 in total operating expenses. If we take that $372,500, subtract it from the $450,000 gross profit, it leaves us with operating income, or an income from the operation itself, or earnings before interest and tax of $77,500. So from a set of transactions, revenue coming in, spending money on the cost of goods that we sold to get that revenue, and then spending money on the remainder of our operating expenses to be able to run the operation, we're able to construct the majority of the income statement. All that's left are non-operating expenses. As we look at depreciation and amortization of the operation, we're remembering that these were not paid in cash. In this case, we know that we were depleting or depreciating the value of those fixed assets, supposing that they had a useful life of 8 years. In accounting, we must conform to what's referred to as GAAP, generally accepted accounting principle. And GAAP dictates how we're allowed to depreciate different kinds of assets. Without going into too much detail there, by and large, most firms will depreciate assets by taking what the asset cost and dividing it by the number of years that they believe they'll be able to productively use the asset. We typically account for depreciation on an income statement as we communicate with the public, and sometimes the public is the Internal Revenue Service. And when we communicate with the Internal Revenue Service, we're required to use depreciation from a schedule that the IRS gives us. Regardless, we're going to end up with an operating income of $77,500. And now we're going to recognize that after the operating income, we had to go ahead and pay $10,000 on interest expense, and then we had to pay $17,550 on state and federal income taxes. We see those on the non-operating expense part of the income statement, resulting in net income or profit of $49,950. You can see the structure of this as we've gone over on the income statement. And sometimes it's nice to see at the end of the income statement not only the net income, but what we did with the net income. Maybe we distributed some of it out to stakeholders in dividends or distributions. And maybe we just kept the remainder of it as a reinvestment in the company, as we did in this case. You should now be prepared to complete the Rocky Mountain Catering income statement assignment. This is the second in a series of assignments to assist you in better understanding the construction of financial statements and prepare you to complete the review problem at the end of the course. My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.